Imagine you had $50,000 sitting in your hands back in January of 2015. Just $50,000. Maybe it was an inheritance. Maybe it was savings you'd been building for years. Maybe you sold a car, cashed out a 401k, or got lucky at a poker table. Whatever the source, you had 50 grand and you needed to do something with it. Two of your friends pull you aside at different moments. The first friend says, "Listen, buy a rental property. Real estate has built more wealth in America than almost any other asset class. You'll have something real, something tangible, something you can touch and drive by and hand down to your kids. Rent it out and someone else will pay your mortgage. In 10 years, you'll be sitting pretty." The second friend, maybe slightly more intense, maybe with a laptop open at midnight, says, "No, no, no. Buy Bitcoin or Ethereum. This is the future. Digital money, decentralized finance, technology that's going to reshape the entire global economy. In 10 years, you won't believe the returns." Both of them sound convincing. Both of them have numbers to back them up. Both of them are right, and both of them are wrong, depending on which year, which market, which asset, and which version of investing you're talking about. So today, we are going to settle this debate. Not emotionally, not ideologically, not based on Twitter arguments or Reddit posts. We're going to look at the cold, hard, sometimes uncomfortable data. We're going to compare cryptocurrency and real estate head-to-head across a full decade, 2015 to 2025, examining returns, risk, liquidity, taxes, accessibility, leverage, passive income, psychological burden, and long-term wealth-building potential. By the end of this, you will not be told what to do with your money. What you will have is a complete, honest, nuanced picture of both asset classes so that you can make the decision that is right for you, your goals, your risk tolerance, and your life. Let's go. To understand this debate, you first need to understand what each of these asset classes actually is. Not in the shallow, Bitcoin is digital gold or real estate always goes up way, but in a genuinely deep, mechanistic sense. Let's start with real estate because it's older, much, much older. Human beings have been buying and selling land for thousands of years. In the United States specifically, real estate has been considered the foundation of wealth since the country's earliest days. The Homestead Act of 1862 literally gave away land to citizens willing to settle it. The post-World War II housing boom turned millions of working-class Americans into homeowners, and in doing so, created the largest middle-class wealth accumulation event in modern history. By the time we reached 2015, the starting line of our 10-year comparison, the U.S. real estate market had already recovered from the catastrophic crash of 2008. Home prices bottomed out nationally around 2011 and 2012, and by 2015, according to the S&P CoreLogic Case-Shiller U.S. National Home Price Index, prices had clawed back to pre-crash levels in many markets and were beginning to climb again. The median existing home sale price in the United States in January 2015 was approximately $188,700, according to the National Association of Realtors. That number would prove to be the beginning of one of the most sustained housing appreciation runs in modern American history. Now, let's talk about crypto. In January 2015, Bitcoin, the original cryptocurrency, was trading at roughly $315 per coin. It had already lived several lifetimes by then. It had soared to nearly $1,200 in late 2013 before crashing spectacularly. The Mt. Gox exchange had collapsed in early 2014 in one of the most dramatic fraud and theft disasters in financial history, destroying billions in investor value. By early 2015, Bitcoin was in a prolonged bear market, and many financial commentators were once again declaring it dead. Ethereum, which would become the second largest cryptocurrency by market cap and arguably the more consequential technological innovation, didn't even exist as a tradable asset until July 2015, when it launched at roughly $2.83 per ETH.
The broader crypto market as we understand it today, with thousands of coins, decentralized finance protocols, NFTs, stablecoins, and institutional investment, was embryonic. It was weird. It was niche. It was mostly populated by cypherpunks, tech evangelists, libertarians, and a small but growing community of speculative traders. So here is the fundamental asymmetry we're working with from the very start. In 2015, real estate was a mature, regulated, widely understood, institutionally backed asset class with a century of data behind it. In 2015, cryptocurrency was a nascent, largely unregulated, deeply misunderstood, and enormously volatile digital experiment that most of Wall Street and most of Main Street either ignored or actively scorned. These are not equal starting points, and that context matters enormously for everything that follows. All right, let's talk numbers, because this is the part everyone wants to know. If you had put $50,000 into each of these asset classes in January 2015, what would you have today? Real estate returns 2015 to 2025. According to the S&P CoreLogic Case-Shiller U.S. National Home Price Index, U.S. home prices rose approximately 90 to 110% between early 2015 and early 2025, depending on the specific region and methodology used. The Federal Housing Finance Agency House Price Index showed national appreciation of roughly 105% over the same period, with some metro areas seeing dramatically higher gains. To translate this into dollars, a $200,000 home purchased in early 2015 with a 20% down payment of $40,000 would be worth approximately $400,000 to $420,000 by 2025. That is nominal appreciation of roughly $200,000 to $220,000. But remember, in real estate, you typically use leverage. You don't pay cash. You put down 20% and finance the rest. So your actual cash investment of $40,000 generated $200,000 in equity growth. That's a return of roughly 500% on your actual invested capital. This is the leverage effect, and it is one of the most important and most frequently misunderstood advantages of real estate investing. Now, if you were renting the property out, you would also have collected rent payments across that decade. For a single-family home in many U.S. markets, average monthly rents climbed substantially, in many cities doubling between 2015 and 2025. This cash flow, if managed well, could represent an additional $80,000 to $150,000 in income over the decade, net of expenses, depending on location, occupancy rates, and management efficiency. So the total return on a well-purchased rental property, counting appreciation and rental income, could easily represent 600 to 800% on actual invested capital over this 10-year window. Now, let's talk about crypto. Here is where the numbers get genuinely staggering. Bitcoin in January 2015, approximately $315. Bitcoin in January 2025, approximately $95,000 to $100,000, having hit an all-time high above $108,000 in December 2024. That is a return of approximately 30,000 to 32,000% in nominal terms. A $50,000 investment in Bitcoin in January 2015 would have grown to approximately $15 million to $16 million by early 2025. Let that land for a moment. Ethereum in July 2015, its earliest tradable period, approximately $2.83. Ethereum in January 2025, approximately $3,200 to $3,500. That is a return of approximately 112,000 to 123,000%. A $50,000 investment in Ethereum at launch in July 2015 would have theoretically grown to somewhere between $55 million and $61 million by early 2025. These numbers are on the face so absurd that many people's first instinct is to dismiss them. That can't be right. But it is right. And that's exactly why the crypto versus real estate debate is so emotionally charged. Because when you show someone a chart of Bitcoin's 10-year performance next to a chart of real estate, the crypto chart makes real estate look like a savings account. But, and this is absolutely critical, this comparison is fundamentally misleading in several important ways, and that's what the rest of this script is going to unpack.